This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
We got our last couple in the quad rented, and we got the last one of a duplex rented. And so we have full occupancy, and it sure feels good to get the full check every single month. It's just a great feeling. And so hopefully in December, we're going to take over 2 more. And actually before then, take over some from Alabama, actually all, and then Memphis as well.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Greetings, empowered investors, and welcome to episode 2315. Today, we are going to talk about how income property is the most tax-favored asset class in America. And one of those aspects, of course, is the incredible, super powerful, magnificent 1031 exchange. We're not just going to talk about the 1031 exchange. We're going to talk about several different tax opportunities to save money on life's single largest expense, taxes. So we're going to get into it today, and it's going to be a good one. Be sure to always register every month for our free masterclasses at jasonhartman.com/Wednesday. That's jasonhartman.com/Wednesday. The last few of them, we had such extraordinary, incredible feedback. Thank you so much for that. Really glad you're getting a lot of value out of these free masterclasses. So be sure to join us for those every single month on the second Wednesday of the month. And register always at jasonhartman.com/Wednesday. Without further ado, here is Scott Saunders as we talk about tax saving opportunities. It is my pleasure to welcome a good buddy of mine, Scott Saunders, back to the show. He is with API Exchange. He was one of our speakers at Empowered Investor Live, and he is so knowledgeable about all things, well, I don't want to say all things, but a lot of tax vehicles and strategies, which are great. His main background is in 1031 exchange. You've heard him on the show before, but he's got some new numbers to throw at you today, some that I haven't heard of. We're going to hear some new tax code numbers, not just 1031. Scott, welcome back. How you doing?
Jason, great to be with you. Awesome. Always love visiting with you and chatting back and forth.
Likewise. So you have 3 main points you want to cover today, I know. And I think you should start with the 1031 exchange because that's sort of your core area. And that's what most listeners know about too. And then let's go into some of those other ideas you mentioned to me.
Yeah, well, I wanted to kick it off with that. I think right now in the marketplace, when we are looking at doing a 1031, this is really a great time to be exchanging because as a buyer, you've kind of got the pick of inventory that's out there. The market's a little slow, transactions are down. And when we do an exchange, the biggest challenge people run into is identifying a replacement property and those time deadlines of that 45-day window.
Those have been very stressful for me before. Yes.
They are for everybody, Jason. You know, they're challenging because they're set in stone. There's no flexibility. So one thing I wanted to share is just, I think it's a great time to consider exchanging because as a buyer now, you've got a little bit more leverage.
You've got some choices.
Yeah, you do. You got some options out there and you can pick a good asset and maybe even negotiate them down a little on the price, speed them up. So the one big variable of the exchange, when we were frothy down in COVID, when everything was turning over so quickly, it was hard to tie something up. Properties would get on the market and if they were priced right, they'd sell in a matter of days. Now, I think we've got a position where you can go in and you can lock up a good property and take out some of that stress, right? Make an offer on it and get it locked up because the sellers just don't have everybody beating down their door in a lot of the markets nationally right now. So
I couldn't agree more, Scott. And I've been trying to work up a new real estate and marketplace theory of mine. I really dove deep into this last weekend, and it's this idea that the fact that we have more selection now, although certainly we're not back to even normalcy, we've got about 760,000 homes for sale in the country right now versus normal, quote unquote, would be about 1.4 million. That's the 2015 number of normal, which I would argue isn't even normal anymore because the population's increased by then. But that's, let's not go down that rabbit hole. The point being that there's a lot more selection than there was during the COVID era, where we got as low as 240,000 homes for sale. So inventory has tripled from the lowest point in history, and it's about half of normal. But the thing that's happened with these high interest rates is demand destruction. I mean, that's what the Fed wanted, and that's what they got. They got demand destruction because of the higher rates and already increased prices that they set those rates into. So what I'm thinking is that there is not just a value on being able to negotiate a little bit. Of course, that's a value to the buyer, right? But there's a value just in the pure having of more selection, right? There's literally a value. I think you could put a number on that to just having more selection. Like, I'm home shopping right now for a home for myself, and I love it. There's actual choices. I did this same kind of shopping about 2.5 years ago. There was no choice. It was terrible. And just the fact that I have choice, the prices are actually a little bit higher slightly, but God, it's just great to have choice and get what I want.
yeah, no, absolutely. And I think what you're experiencing on the home side, looking for a residence, that's what investors have on the investment side. They got the same thing. They've got options, they've got choices. And so when people are working with your counselors, your investment people, they've got options they can line up, especially with a lot of these turnkey providers and new construction. They can look at kind of what's coming in their pipeline and say, okay, I'm selling a property with this amount of equity and debt, and I want to go into 2 or 3 replacement properties. They can look at their pipeline of what's coming up and say, okay, here's what I've got. Let's line them up. They win because now they get a guaranteed buyer, so they're happy.
Right.
And then the investor wins because now, instead of going into the market and hoping they find a good replacement asset, they get it locked up and under contract. And that takes a lot of the mystery and stress out of doing a 1031. So I just want to emphasize this is probably one of the better economic environments to be a buyer and to be buying into different assets that are out there.
Yeah, absolutely. Good stuff. So do you want to get to your second point now, your second main point?
Yeah, the second one, I'll just kind of open it up. So you got 1031 that deals with any property held for investment. Defer taxes, and you're just deferring the gain. The other tax code section that a lot of people are aware of is called Section 121. This is just your primary residence. You live there 2 years out of 5, and you're able to exclude $250,000 in gain if you're single, $500,000 if you're married. So that's been around since 1997, that provision. What I want to talk about...
It was actually better before that because you could have an unlimited amount. Well, kind of better and worse in 97, where you could have an unlimited amount of gain and just roll it into a new property and not pay capital gains, right?
Yeah, it was different. Back then, it was called Section 1034, and they changed it.
Yep.
What's interesting, I will share with your audience, it's not going to make it in this new, big, beautiful tax bill that's going through Congress, which I'm following pretty closely. But there are kind of a bipartisan effort with people on both sides of the aisle to sometime go back, and it's time to look at bumping up those thresholds. So we had the law on 1997, $250,000 single, $500,000. Well, that's a long time ago.
Houses were a lot cheaper.
They were a lot cheaper. And so what you have now is, because of inflation, really, because of variables that we have no control over, asset values have gone up a lot. And those thresholds don't really allow you to exclude nearly as much gain in today's world in 2025. So the National Association of Realtors is actually working with people in Congress. There seems to be kind of broad agreement that it would be fair to double those amounts. And that would be a big game changer for a lot of people.
And of course, all those politicians own expensive homes that they'd like to trade and not pay tax on.
Jason, you hit the nail on the head. That's how tax law works, right?
Yeah.
It's for the average person, but it's for people in Congress and for a lot of their buddies too. So
right.
So anyway, that's a provision most people are familiar with. What I want to talk about a little bit are some neat opportunities. So the first one is what we call a split treatment transaction. And this can take a lot of different forms, but let's just make it a simple one. Somebody buys a fourplex for investment. They live in one of the units, make it their home, and then they rent out 3 units. So
now, would that be a split treatment or a 25% treatment? I'm curious how the IRS views that. Because I know where you're going, but maybe you want to tell the audience. Yeah.
So you call it, it's a good question. You call it a split treatment because you're going to really work with your tax advisor to come up with the allocation. If I'm buying let's say a B class fourplex, the odds are as an owner, I might fix it up a little bit, right? I might go in and it's got old Formica. I'm going to put in upgraded quartz. I'm going to upgrade it. So my owner's unit may not be just 25% of the complex. It may be 30 or 32% of the value because I fix it up. So there's an allocation issue.
And so if I'm married, I got 500,000 just on my residential part or personal residence part, and then the rest I've got a 1031, right?
Exactly. And so think about it. You would want to skew as much value as you can into your residence because it's tax exclusion, not tax deferral. So as much as you could reasonably argue, and make an argument for, you'll be better off. So this is a common.
This is good for house hackers. For house hackers
are great. So here, I'm giving you a simple example of a fourplex. So let's just say for simplicity, a quarter of it, I do a 121. I sell it. I put all that gain in my pocket up to the limits. Then I do a 1031 exchange on the other 3 units into other property. So that one's easy. You can do it a fourplex, triplex, duplex. But here's some other applications with it. People do Airbnb. Maybe you've got a couple dedicated bedrooms and a little studio kitchen down in a basement, and you Airbnb it in your house. You got a separate entrance. That's another one. You've maybe got a detached garage with a mother-in-law unit that you rent to a college student. That's another one. There are all sorts of different ways to do this. I had a good friend here.
So these are all split transaction opportunities, right?
Yeah, they're all split.
Okay, so let's just analyze that for a second. If you had a home that was maybe a more expensive home, and you had more than the 250 worth of gain if you're single, or 500 if you're married, so you allocate more to the rental unit because then you can defer that gain indefinitely and all your life, and then you can die, and then the basis will step up. So there's no tax paid, right? That's
exactly. So you can use it either way, right? You're going to kind of look at your situation and how much gain, and you've got a little bit of a fudge factor there on the allocation of whether you want to put more than 121, the primary, or a little bit more on the investment portion. But there are so many applications. I had somebody here that sold a home they lived in. They're a home builder, and they used their home. They basically had a large garage where they kept all of their materials, and they had a large home office. Well, that's part of their business, but it qualifies for 1031. So we carved that out in an exchange. They exchanged and paid cash for a property in Memphis, Tennessee, and that provided their retirement income all out of their home. So you got all these different ways, Jason, to do it. You could do it. Think of a rancher, right? I've got a modest ranch house, but I've got $2 million of ranch land. There's ranches, farms. So there's just a lot of different ways to kind of allocate this, but you're going to use both tax code sections to your advantage there. So
interesting. Yeah. The split transaction is a really interesting opportunity for anybody that has an income property combined with a personal residence.
There you go. And think income property, or even think, a home office. If you've got a large home office, same thing that you're writing off and you're depreciating. Income property, or, something you use for business use, it could qualify. I'll give you an example, Jason. In my house, a third of my house is business use. My entire basement, which is a third of my house, it's all business use. It's where I run my real estate business and do everything. There's no other use for it. So when I go to sell my home, 1/3 of it I'll exchange for another asset. The main level and the upper level, I'll take the 121 exclusion on up to the limits. So I just thought it's a neat planning opportunity to look at an asset, not just as being a home, but saying, hey, is there the potential to maybe treat it this way and take advantage of it? So a lot of people might apply.
I have talked to you many times about my experience with a gold dealer years ago. And the one major flaw of precious metals investing when it comes to gold and silver, and that is that it does not produce income. But what if you could make gold and silver work for you just like your income property? Well, you can. Our new sponsor is Monetary Metals, and people who own gold as a hedge against inflation like that feature, but the gold just sits there. It's collecting dust, right? But with their leasing program, you can actually earn a yield. So check out our new sponsor, Monetary Metals, and it's monetary-metals.com/Hartman. And you can learn more about this opportunity. Instead of paying to store your metal, you can now get paid to own it, earning passive income paid in more ounces of real physical gold every single month. With Monetary Metals, you can earn up to 4% in their leasing program immediately upon funding your account. Yields are paid monthly in ounces of physical gold or silver, which you can get in addition to any price appreciation from your gold and silver over the holding period. Fund your account with metal you already own or purchase it from them at less than 1% over spot. I liked this product so much, I signed up myself. Gold and silver are a great insurance policy. Again, I never really treated them as an investment. They were just kind of an insurance policy. But now you can earn a return of up to 4% on that insurance policy. So it just got a lot better. Visit monetary-metals.com/Hartman and learn more about this program. You know, I'm curious, Scott, do you have any insight onto the home office deduction in terms of what percentage of that house can someone get away with? And I don't mean get away with illegally, I mean legally. I'll tell you, just make a statement about my own situation. In my last home, I made sure I filmed YouTube videos in every room. Well, not the bathroom, but in all of the rooms, I did a video and I conducted business in all those rooms. I don't know if that matters, but I'll just tell you.
Well, I think that's one way to do it, to make an argument. Typically, the way the IRS will look at it is they'll look and see, do you have 100% dedicated use? So I'll give you an example. My basement, my son used to live there. He went to college. So then I converted his bedroom to kind of a recording studio. And then I moved all my desks. So I've got a desk for myself to work. I've got a reading room where I read real estate books, right? Financial books. I've got a desk for me. I've got a desk for my daughter who helps out with my accounting. So what I did is I pulled out anything that was residential. There's not a bed down there. There's not a TV for personal use. If I took pictures of it, so it's 100% business. So my take on that would be the IRS wants to see that it's 100% dedicated, that there's no cross-pollination, that you can't use that space for anything else. So the extent you can do that is probably the best way to do it. Yeah. I'm not giving tax advice, of course.
Right. Yeah. We should make that disclaimer, by the way. Scott is not a lawyer. He's not a tax advisor. He does happen to know a lot about tax, but check everything with your own advisor because this stuff's complicated, folks. You know that, and everybody's situation differs.
Let me just go to just two little branch off of the 121. So sometimes we get asked, what if I buy a nice home on a golf course that I rent out for a while, but I want to move into it? So I do a 1031 into a $2 million home on a golf course. You can do that. So your initial intent has to be to hold for investment. A few years down the road, your intent changes. You decide to move into it. That's permitted. If you later go to sell it, you've got a 5-year holding period. So you've got to hold the asset for a minimum of 5 years. But what's interesting is you don't get the full 121 exclusion. So let me give you a scenario. I do an exchange. I rent it for 3 years. I move into it. I live there for 5. So I've got 8 years of ownership. I get 5/8 of my 121 exclusion. So I get a ratio. The longer I live in it, the closer I get to full 121 exclusion. So there's a potential, though, to do an exchange and then later on move into it. So you're in Florida right now. We have a lot of people that may exchange into Florida, rent it out for a few years, but they intend somewhere down the road to move into it and make that a second home or make it a residence in the winter. So the 1031 provides that tool. So that's what that strategy is. Now, the third one is a great strategy. So Jason, you're going to love this for people on the coast that have had a lot of appreciation. So let's say somebody bought a house in La Jolla, California. 300 grand. Today
Right.
it's worth $5 million, right?
Yep.
It's
I
appreciated.
used to live in La Jolla. Yeah.
You know the market. So, and let's say this happened over 30 years, right? It didn't happen overnight, but it's gone up a lot. Most of their net worth is in that primary residence, right? They got it worth $500,000, it's paid off. There is a way in the code where you can now take advantage of 121 and 1031 together and combine them. So you move out of your La Jolla house and you make it a rental. And let's say you rent it for just a year. So I do a 12-month lease. Now I list the property in La Jolla. Well, it was my primary residence for 2 out of the past 5 years. So I get the full 121 exclusion. Let's say they're married, they're able to pull $500,000 off of that. So now they've got $4.5 million left. They then do an exchange with that $4.5 million to a lot of the markets that you talk about, Jason, a lot of the Midwest markets where you can get a good value.
Southeast, yeah.
Yeah, they buy there and they buy a whole bunch of single family homes. I know somebody that bought 32 homes out of a property they sold in Southern California. They bought 32 homes in the Midwest. Now you've just converted all that equity that was in your home, and now you converted it into investment equity that's going to kick off retirement cash flow that keeps up with inflation, and you get all those benefits. So I think that's a really interesting strategy for people that have a lot of equity in their home and maybe not a lot of equity in other ways to kind of unlock that equity, use it to provide retirement cash flow and kind of convert it. So it's a pretty simple way to do that. And we've got guidance from the IRS. This is 100% legitimate.
Yeah. And Scott, we've done the more traditional version of that many times. I mean, many times, where someone will sell an expensive, usually California property, right? They might have inherited it. We had one client, I remember specifically them, who inherited it. They sold the property. We helped them set up their 1031 exchange with your company. And they bought, I think, 37 properties. They converted one property that was a vacation rental that was hit and miss. It wasn't, they didn't want to manage it. They didn't want to deal with it. They converted that to 37 long-term, high-quality rental properties. I mean, their cash flow, we did a show on this when it happened. This was years ago. I mean, it was phenomenal because that property they inherited, it was free and clear. It was like $2.5 million or something. And they were able to leverage that into 37 little rental properties, like entry-level homes that those have probably all doubled in value by now. And their cash flow is dramatically better. They were very happy and very thankful about it.
Oh, yeah, that's a great strategy. Plus, you get 37 assets. What if one of them's not that great? You still have 36 great ones. So
I know, you can just get rid of the one that you
asset.
don't like. Yeah.
Yeah, you got all the diversification. No, that's a great strategy. So it's a way to kind of unlock your home equity and make it some investment capital that'll work with you. And you just got to jump through a few hoops on that one.
Absolutely. Okay, you ready to switch gears to your third big strategy?
Let's go to the big one.
Yeah, so this one, look, I'm not a fan of this one. I'm a fan of the strategy. I'm not a fan of sticking your money into where it's going to end up. But, some people want it because they just don't want to deal with anything. They want to shift it into neutral and just coast. Maybe they're at that point in their financial life, and, that's understandable. But tell us the strategy, or first outline the problem here, if you would, and then tell us the...
Yeah, so there probably are two different problems. So one problem with a lot of investors is they want to go passive. They don't want the active ownership. They've been working at it for years. They want to take care of the tenants and all the mess that goes with owning property. They're just kind of ready to say, hey, I want to offload that. The other strategy, and I'm going to kind of give you kind of a hybrid here. We get asked all the time, can we do an exchange into a real estate investment trust? So they're known as a REIT. So a REIT owns typically a diversified portfolio of assets. So they'll own, 100, 200 commercial properties of whatever asset class they like. So they're industrial REITs, they're apartment REITs, they're, office REITs, all sorts of different types. Short answer is you can't do a 1031 and get into a REIT because your share in the REIT is considered personal property. So the REIT owns real estate. But if you want to exchange into a share, that's personal property. It doesn't work. So I can't do a 1031 into a REIT to go passive or get diversification. That's kind of the scenario that we run into.
In other words, no 1031 opportunity. The problem is you'd have to sell the rental property, pay capital gains tax, and then invest what's left over. And what we love about income property is we can keep trading it at full value throughout our life with the 1031 exchange. But
Exactly.
there is a way around this for a REIT. If you want to downshift into slow mode and get just a boring REIT, you can do it, right?
So yeah, what I'm going to kind of do is I'll bring in a whole nother tax code section. So there's another provision in the code, and it's called Section 721. And what it is, it's something that REITs use, and it's where you can take your commercial property and you contribute it to a REIT in exchange for what are called OP units in an umbrella partnership. So it's called an UPREIT, umbrella partnership in front of REIT. So if I have an apartment building worth 20 million and my apartment REIT wants to take my asset, they want to acquire it, I contribute my $20 million apartment to the REIT. They give me OP units in the REIT, and the OP units essentially are the same as REIT shares. They track. So this is something that's been in the code for a long time, but it only works for a really big commercial investor. You have to have an asset, a really good sized commercial property that a REIT wants to acquire. And a lot of investors don't have huge commercial assets, apartment buildings, shopping centers. So that's in the code, and people use that on the commercial space. So what I'm going to share, Jason, is there's a strategy where the smaller investor can take advantage of that same strategy. So here's what you do. It's kind of called a two-step transaction. I do a 1031. Let's say I'm in California and I got $1 million rental house. So let's say it's free and clear. Step one, I get a buyer for that, and I do a 1031 exchange into what is called a Delaware Statutory Trust, called a DST. So now I'm in a new vehicle where I own a little beneficial interest with a bunch of other co-owners in this Delaware Statutory Trust. So that's step one. And those are fairly popular out there. There's a whole industry around DSTs and TICs. So the reason I do that is I want to go fairly passive. And we could talk about them. They're
so let's explain this a little bit. So yeah. I know that you're not a big fan of DSTs, which is the Delaware Statutory Trust, right?
Well, I think there are a lot of fees associated with them. There's some positives, but there's some negatives. There's a lot of fees associated with them.
Got it. So it's high cost to do it. And then you also mentioned TIC, which means tenant in common. Okay. And TICs were very popular about 20 years ago. They were all over us trying to get us to promote them to our clients. We never did. Right. We didn't like the TIC vehicle very much, but that kind of blew up because the IRS had a determination on the TICs, right? Just for a little history here.
Well, the TICs kind of blew up because of the real estate downturn. A lot of them, unfortunately, were being promoted. So that's Revenue Procedure 2002-22 that supported that. So the TIC vehicle is a way to do it. What happened, though, is with the downturn, a lot of people went into TICs and they weren't suitable and they had capital calls. So now you got grandma who thought she had a passive investment getting a letter from her TIC sponsor saying she has to throw in $40,000 because they need to get a new tenant in there. And so a lot of them...
And I'm so glad you mentioned that because, folks, look, we are not a fan of syndications, TICs, or these pooled money investments. And, a lot of people think, well, I don't like my rental properties because, I'm going to have to replace a water heater. That's like a capital call, right? And folks, you can get those in syndications too. I've had them. I've been the investor and I've had the capital call, and it's like, put in some more money or lose your investment, right? So what am I going to do? I'm going to throw in more money. It sucks, but TICs and all these sort of pooled investments like syndications, they get capital calls too, just like you get a repair bill or a vacancy.
Yeah, Jason, I'm so glad you brought that up. So that's a really important point. These are marketed by the financial advisors as kind of, they call them coupon clippers or mailbox money, all these different terms, right? They talk about the yield coming in. And the reality is you're still buying a piece of real estate, and you buy real estate in a market, and some markets are going up, some go down. Sometimes you have tenants move out and you need to get a new tenant. So real estate is it's variable. You and I know that, right?
Yeah,
it depends on the market and tenants. These are kind of promoted by the financial advisors saying, well, you'll just get this return of X, whatever.
No, you won't. Nothing's guaranteed.
Yeah, no, absolutely. And that would be something I would say. If you're looking at these, really look hard at the sponsor, look at their track record. Have they been around a long time? Have they gone full cycle? Or are they relatively new, just kind of promoting it? That's a big piece of it. And then also, obviously, you want to look at the asset. Do I like the market? Do I like the type of real estate I'm buying? Do I like my tenants and the leases? Or do they have rent escalators in the leases? You're going to get, and by the way, Jason, important to point out, these are only for accredited investors. So you have to be an accredited investor. So, your average starter investor may not have the net worth to get into these. So only a certain type. And the SEC considers them as a security, but they do qualify for a 1031 exchange. So you mentioned the TICs. A lot of these now are sold as DSTs, these Delaware Statutory Trusts. There are a couple TICs left. Pretty much the whole industry moved over to the DST structure. The reason is with the TIC, you're limited to 35 co-owners. With the DST, I can have hundreds of co-owners.
So if you're a sponsor and you want to raise more money, you want to be able to have more investors in your deal, right?
Absolutely. So that's why the DST is the better structure. You can pull in hundreds of people. You can do that. So there's a whole industry around this. Today, there are 64 different sponsors that are out there as of today. So you've got sponsors in all sorts of different, you got medical sponsors and retail and shopping center and multifamily. So there's quite a few of these that are out there. What is kind of an interesting play and where I was going with it is you can now do this two-step transaction. So I do a 1031 into a DST, and not all DSTs offer this, but there's now a growing group, probably 10 different companies in the country that offer this UPREIT option. So I stay there for, let's say, 2 to 3 years, and I'm in the DST, and then the sponsor or the REIT gives me an option to take my little narrow interest and do a 721 UPREIT for units in the REIT. So now I go from my DST interest and I do a 721 UPREIT and I get OP units in the REIT. So it's a way to get into REIT shares if that's where you want to go. If you want to explore this option, it does that. Now, there's some downsides to this. Once you've got a REIT share, you can't do a 1031 anymore. So if you sell, you're on the hook for all the capital gain taxes. But the big benefit of this is if I'm in one DST in one market, let's say I'm in Dallas, Texas, I've got one asset in Dallas. When I go into the REIT through the 721 UPREIT, I now get the REITs portfolio. So now I've got 200 assets instead of my one property in Dallas. So some people like this as kind of an exit strategy.
I get it.
Some people use it maybe for estate planning. They don't want their kids to necessarily sell their investments. So they're in a REIT. The kids might hang on to it, or they want to get the passive income off of the REIT. So it's a growing part of the marketplace. Give you an idea, Jason, there's going to be this year something like $4 billion of equity that are going into these. So it's really the big growth market, part of the 1031 market right now.
Is $4 billion considered a lot? Compared to what? Compared to the overall size of the real estate market, that's like pennies. But what do you mean?
It's pennies, but I'll tell you, it's becoming a real attractive option because so many investors, they've got all this gain. They don't want to pay the taxes ever, right? They'd be killed with taxes, but they want to go passive. They don't want to manage it, and they don't necessarily want to buy maybe a triple.
But just remember, Scott, my theory is there's no such thing as a passive investment. Even a bank account is not passive. Yeah, So I hesitate to use that word. But,
I agree with you on that.
There's a spectrum, right? There's a spectrum of passivity. Yeah. Hey, speaking of which, I want to get your take. There's some talk that Trump wants to expand opportunity zone legislation. That's interesting. I don't know what his twist on it would be, or what have you heard? You're talking to congressmen and stuff all the time. So
I was on with a congressman just before you and I hopped on this Zoom, Jason.
Yeah.
That's why I was a little late hopping on it. What they're doing is Trump likes the opportunity zone. It actually worked. It brought capital into these dilapidated markets. So it was a pretty successful program. Trump wants to expand it, and he wants it to apply to more rural areas. They want to expand kind of the scope of it. Now, Trump's just president. The reality is the House Ways and Means and the Senate Finance Committee actually draft the tax bills. So he doesn't get to necessarily write the actual legislation, but he's got his hand on the wheel of kind of trying to guide it. So right now, as what's proposed right now, we've got some great things coming out. So for your listeners, it's not signed. We're not done. But one thing that's coming out in the new tax bill that's working its way through Congress, they hope to kind of have it ratified in the next month or two. One thing that's huge is we're going to get 100% bonus depreciation starting January of this year.
That's looking like it's almost positive, that's going to happen.
Yeah, I think it's looking good. The opportunity zones, if the bill goes through, the opportunity zones will be there and they'll be expanded now to include more rural areas. So they're trying to get some of these, kind of the markets that are soft down rural areas, draw capital in them to get them to grow and expand.
Yeah, very interesting. Okay, well, Scott, what else do you want people to know before we wrap it up today?
You know what? If you got questions, you know where to reach me. API Exchange on the internet. And, use a good QI. I would say anybody doing it, for number one thing.
A QI is a qualified intermediary.
Thank you. A slang word there. Qualified intermediary. We're called QIs, qualified accommodator, facilitator. Number one thing to know, you guys, don't sell an asset and pay all your taxes. You've got legitimate parts of the code. Keep all that equity, redeploy it into better performing investments. There's really no reason for a real estate investor, in my opinion, to sell and pay taxes if they're going to go out and buy more real estate. The only time you want to do that is if you're done with real estate and you want to go into other types of investments. But we've got this thing in the code since 1921 that gives us a big leg up on other investors. Why not take full advantage of Section 1031?
Yeah, as I always say, income property is the most tax-favored asset class in America. It's the most historically proven asset class in the entire world. And, taxes, back to that, are the single largest expense most people have. So, Scott, it's great having you back today. You're so knowledgeable. We really appreciate it. And you can connect through Scott's website, as mentioned, but all of our investment counselors are in touch with Scott all the time. So they're happy to connect you as well.
Thanks a lot, Jason. Great being with you.
Thank you.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.